Makwidiri, and we're going to be looking at South Africa's economy in a surprising shift that's caught the attention of investors, markets, and everyday South Africans alike. Treasury and the Reserve Bank are reportedly preparing to formalize a lower inflation target, signaling that South Africa might be entering a new era of low, stable prices. In its simplest form, that's what it means for you and I. Governor Lesetja Kganyago has already dropped hints saying inflation expectations have shifted and that the timing is right to lock in disinflation gains. And in just a moment, we'll speak to political economist Dr. Dale McKinley to help us unpack whether this bold is this a bold policy or just mere optics. Can South Africans expect an era of low prices? Cost of living is skyrocketed for the last few years. And we'll be unpacking that. What would this new policy mean for your wallet, for your business, and for the national economy in general? Dr. Dale McKenzie is joining us via our streaming platform. Doc, thank you so much for joining us. Good morning. Always a pleasure having you on Salam Media.
Yes, good morning. It's always a pleasure to be here. Thank you.
No, pleasure's all ours. I think let's jump right into it. The headline narrative seems to be so powerful. South Africa entering a low inflation era. But how confident are you that this move to formalize a low inflation target is more than just political posturing, as we've seen, so many times? And where exactly might the gaps lie between this kind of announcement and also the real world delivery, which its effects can be felt by everyday South Africans?
Yeah, I'm not convinced. I don't think it's a fundamental shift at all. I think if listeners remember, for the last several years, the Reserve Bank has basically had a targeted inflation range, 3 to 6%. This is their target range. And what they've been doing is gradually trying to get it down into the middle range for the last several years, and now they're saying no, they want to go to the low range, which is the 3% target. Now, the assumption here, in as you sort of made reference to in your introductory remarks, is that if we have a lower low inflation rate, then prices across the board will be coming down, or at least they'll be more stable, which is to some extent true. But there's several things that this does not take into consideration. The first thing is that what you're looking at when you talk about a inflation rate, a CPI, consumer price inflation, is an overall inflation rate. So it's everything put into one basket, and you get this 3.5%. That doesn't take into consideration different inflation rates for different things. So, for example, if you take food, if you take fuel, if you take particular things that are needed by working class and poor people, for the most part, transport, the inflation rates for all of these things are generally higher. In fact, the food inflation rate overall has been riding at least 3 to 4%, if not more, higher than the average CPI. So what this tells us is that while you can target a low inflation rate and say this is going to affect prices, it has different impacts and outcomes on different people within the economy. What the policy framework is: lower inflation rates, lower interest rates. So generally what you see is you get a 3%. Well, then we can lower the interest rate, and that makes access to money cheaper. Then the assumption, the theory is that when that happens, it grows the economy because people will spend more money, and this is the general expectation. Unfortunately, that has not come to bear in South Africa. We've been having increasingly lower inflation targets, and our economy has not grown. Our economy is our growth trajectory is anemic. It's basically remained the same. Unemployment, for example, has actually risen or has remained pretty much the same. So the relationship between inflation and the real world of people's lives, particularly working and poor people who are the most affected by slow economies and by high unemployment rates, is very tenuous. And that's the problem we have in South Africa, is that a monetary policy in this case oftentimes benefits those that already have capital, not those that don't have capital.
I want to go back to that inflation targeting framework that you spoke of, that 3 to 6%, which from my research seems to have been long in place, I think since the early 2000s. what technical or legislative changes would have to accompany a shift downward, and what are some of the institutional hurdles that are currently in place preventing that from happening?
Well, there's not, it's a fairly blunt instrument. I mean, basically, the Reserve Bank makes decisions on interest rates. As you know, they basically are targeting using that policy tool in order to try to impact on the inflation rate. Obviously, the inflation rate is also impacted on by a whole range of other factors that are beyond our control. So, for example, fuel prices. When we get these things are not things that South Africa has control over. If fuel prices go up, generally what that does is it has a knock-on effect on the economy in terms of transport prices, in terms of food prices, or whatever the case might be. So there are certain things. There's the real policy, how should we say, the real policy space or room to try to impact is much more on the other side. It's not just the supply side; it's the demand side. In other words, what government does in terms of its spending priorities. So you can't look at one without the other. And if, in this case, if we were to start looking at the other side, in other words, okay, there's a little bit more money in the economy, there's a little bit more investment because the inflation rate is lower, or whatever the case might be, what would be the policy things that government could do in order to take advantage of that? That's where the debate really lies, which is how do we spend our money? Is that money being spent accountably? Is it being spent effectively? So let's look, for example, our infrastructure program, which is billions and billions over the next several years, supposedly to deal with our energy infrastructure, our transport infrastructure. These are the things that have been prioritized. Well, are they working? Are they increasing unemployment? Are they increasing employment? Are they making business cheaper? Is it supporting small and scale and medium scale enterprises as opposed to just big foreign direct investors? The answer, unfortunately, is generally not, because essentially my argument is, and several other economists who are critical of the monetary policy, is that the structure of the economy and the policy decisions are basically based upon those that are the big investors, those that are the big capital, holders in our country, and to please them, as opposed to pumping money into small-scale township economies, making money available to more people in order to grow local economies. So that's where the policy difference lies, is that our government hasn't grasped the nettle, in my opinion, of pumping money into local economies. It's still looking at foreign direct investment and the banks and the interest rates at the big level in order to stimulate the economy. And that's why we have these structural problems.
I think that's very, very important to note. Are there any other, relevant experiences in emerging markets, that are the same size like South Africa, where central banks or treasuries have renegotiated their inflation targets downwards? And what lessons could South Africa heed or avoid from those examples?
Look, I think it's a general, this targeting of low inflation is a general sort of policy frame that has been pursued by many, many different countries, because it has been, we talk about neoliberal economics, the neoliberal version of capitalism, which is, the assumption is that you make it cheaper to borrow money. You make it cheaper to borrow money. In other words, interest rates come down because inflation rates, because you get certainty, price certainty in the economy. And therefore, those who have capital, in other words, foreign, and remember, there was an article just the other day in our press that talked about how banks and financial institutions in South Africa are sitting on 1.6 trillion rand of reserves, and they're not doing anything with it because they're waiting for this policy certainty. So this is the fun. We've got a lot of money in our economy. We've got a lot of wealth in our economy, and other countries where there's a decision to be made. How do you access? How do you basically try to make it that gets invested in the economy? Well, this low inflation policy, which has been pursued by us and many others, the assumption is you're sort of trying to cajole those who have capital in order to invest, because you're trying to give them certainty so that they can make long-term investments. That unfortunately doesn't happen, because it happens within a global situation where everybody's competing for the same thing. So it's like a race to the bottom, a race to the most lowest inflation rates and the most lowest interest rates. So South Africa loses out to another country. And that's the lesson, is that if we're going to play this game, and this is going to be the game that you play in order to try to supposedly improve your economy and to grow the things, you're playing it with hundreds of other, or at least scores of other countries around the world, which are in similar situations as you are. So it demands, I would argue that what we need to do is look on the other side of the equation, which we haven't been able to do or have no political will to do, which is to say to buck that trend and to actually have an expansionary fiscal policy which pumps money into the economy in order to help those at the lower end. It risks certain inflationary pressures in the medium and short term, but in the longer term, the argument is that this is what would stimulate the economy. This is what would deal with unemployment. And unfortunately, there's not too many examples in the world right now because most countries are being hamstrung by the international situation and fiscal situation and pressured in order to adopt these kinds of policies.
Just looking ahead, Doc, what are some of the indicators should ordinary South Africans be tracking over the next, let's say, 6 to 12 months to assess whether the transition that is being, reported here by the South African Reserve Bank is real and not just rhetorical, as you seem to suggest?
Well, it would be very simple. Let's track our growth rate in the economy. Is our growth rate, this is the assumption that it'll influence and the economy grows. Otherwise, what's the point? Otherwise, you're just playing with numbers. So let's see, does our economy grow? The second thing is, does our employment rate go down? In other words, are more people employed because the theory is there's more investment and this trickle down, to the workers at the bottom from the investment at the top, this happens. These are theories that have been applied for the last 40 years. This is why I said it's nothing new. They're just adjusting that theory downwards as opposed to upwards. And those would be the fundamental things: employment and growth in the economy. And what does that mean when you say growth? It's what kind of growth in the economy. So not just growth as in, well, we've got new foreign direct investment worth 50 billion, like our president says. Did it have job creation potential? Did it employ people? Did it make sure that the local economies in our failing small cities and towns, which are in crisis economically, as well as in many urban areas, are they being pumped with new capital? Are we growing local economies? And we can measure that. And so that would be the measurement of any kind of success of this policy. That's why I'm very cynical about, well, not cynical, but I would say sort of very cautious about embracing this policy, because there's been no proof that it actually works for the majority of people. And that's the real test in South Africa, because we have structural problems in our country which are preventing us from gaining this growth potential and gaining this employment potential, precisely, I would argue, because the monetary and fiscal policy is not designed to basically help the majority. It's designed to help the minority.
I'm going to leave it on that very sad note, Doc. Thank you so much for always giving us your time and for those very, very important insights. Really appreciate it.
My pleasure. Thanks.
There you go. That was Dr. Dale McKinley, political analyst and economist, helping us cut through the headlines and giving us a bit more insight on what Treasury has announced. If you just joined us, South Africa's Treasury and Reserve Bank are essentially saying that the country could be entering a new low inflation era. And what that means, simply put, is prices for everyday goods like food, fuel, and transport may start rising more slowly than before because government and the Reserve Bank are planning to officially lower the inflation target, which is the range they use to keep prices increase under control. And if this works, and Dr. Dale McKinley seems to suggest that, well, it's just rhetoric, it could make living costs more stable, interest rates a bit lower, and also attract more investment. It is a bold promise, and many economists warn that global shocks like the oil prices or a weaker rand could still push prices up again, further influencing the cost of living here in South Africa. So that's about it. We're going to take a quick break. When we come back, we'll be shifting our focus from economics to immigration and human rights. We'll be speaking with Dr. Faisal Suleiman about mounting concerns over Israel's immigration to South Africa. So stay locked to News and Views. We'll be with you after this.